Hey guys, it's Professor Wade. I'm just here to talk to you about the financial statements and the relationship of the four financial statements. So this is from Learning Objective 4 and 5 in the textbook. So what I've done is I've made up a fictitious company, ABC Corporation, and we're looking at the financial statements. Year-end date is December 31st, 2018. So some of the financial statements you're going to be looking at for a period of time. So in this case, it's going to be the year ended. If you look here, sorry about that. So for the year ended right here, other financial statements you're going to notice are going to be as of a specific date, which will be the year end date, December 31st, 2018 in this case. So I'm only presenting 1 year, but you're going to learn today or when you're in your readings that we do show comparative financial statements, so at least a minimum of 2 years, so the most recent year, the current year, and the most recent prior year. And you'll see why in a little bit. So we're going to start with the income statement. The income statement is always prepared first when we're actually preparing it from scratch. The income statement is showing us revenues minus, and I'm going to show that in brackets because that's how we do it in accounting, minus expenses equals either net income or net loss. So in this case, what we're going to see here is revenues up at the top. And notice here, I did circle this. We're using dollars, and we need to tell the reader that we're using dollars. The system in your homework should do it automatically for you. So they have two streams of revenue, net sales revenue, so sales of goods, and they have other revenue, so they probably provide a service. Whenever you see this single underline in accounting, that means that we're either adding or subtracting the numbers above because we're subtotaling. So what I've done is I've given you little asterisks here. Those are our subtotals in the income statement. So net sales plus, in this case, other revenue, because it's two streams of revenue, equals total revenue. We're going to then subtract our cost of goods sold, which you can read the definition in the chapter, to calculate gross profit. After gross profit, we're going to subtract our selling, general, and administrative expenses, which are our normal operating expenses for the company. So everything such as telephone expense, insurance expense, rent expense, salaries expense are going to be included in here to calculate income from operations. Last thing we're going to subtract is interest expense to calculate income before income tax expense, and then income tax expense to calculate net income. Net income, notice, has a double underline, which means that we're done with this statement. Net income or net loss. Net loss happens when you have more expenses than revenues in a period. Net income happens when you have more revenue than expenses. So our revenues earned are greater than our expenses incurred. In this particular case, we have net income of $20,000. So the second financial statement that we're creating is the statement of retained earnings. So how did retained earnings change year over year? In order to calculate the ending balance of retained earnings, i.e. the balance as of December 31st, 2018, we need net income from the income statement. So we have to prepare the income statement first. So notice here, same corporation name as the income statement. Statement of retained earnings. So now we're moving on from the income statement, statement of retained earnings. And right here, we have the same for the year ended December 31st, 2018. So exactly the same as the income statement. It's for a year's period of time. So first thing I want to point out in the statement of retained earnings, it is obviously much shorter. We have retained earnings, comma, December 31st, 2017. This is our beginning balance. This is what we start the year with. They had earnings that they've held on to and not distributed as of December 31st of $25,000. That's our starting point. Then we're going to add in net income from the period, from the income statement right here. And we're going to calculate, again, notice the single underline. We're going to calculate a subtotal. In this case, notice it tells us what to do. We're going to add retained earnings, beginning balance, plus our net income. The next step is we're going to subtract those dividends. So distribution of earnings to shareholders, $10,000. Notice I'm using the brackets over here. And the very last thing is that we're calculating the ending balance of retained earnings. We need the ending balance of retained earnings to balance our balance sheet. The third financial statement that we have is the balance sheet. So the balance sheet is showing us that our assets indeed equal our liabilities plus our owner's equity. In my case, I called it stockholders' equity, so it is a corporation. It's stockholders' equity or shareholders' equity. It's the same thing as owner's equity. Right here, we have our assets on the left, and we have our liabilities and our stockholders' equity on the right. Notice that we still have the same company name. We still have the balance sheet, which is our statement that we're looking at. But notice that the dates are slightly different. Instead of for the year ended, we're looking at our assets, our liabilities, and our owner's equity balance as of the last day of the year. So it's telling us on a specific date, this is what they had in assets, this is what they had in liabilities and owner's equity. The balance sheet, we classify our balance sheet for our assets and our liabilities, meaning we separate our current assets from our long-term assets and our current liabilities from our long-term liabilities. We also order our balance sheet in a specific manner. So assets are going to be listed in liquidity order. How quickly can these assets be converted to cash or used? Anything that will be used or converted to cash within 1 year from the balance sheet date is going to be classified as a current asset. So notice that we have cash. Cash is always the most liquid asset. You don't have to do anything to make cash cash. Accounts receivable, next most liquid asset, followed by merchandise inventory. So we have to sell the inventory in order to have cash. We have to collect accounts receivable to have cash. So accounts receivable is more liquid than merchandise inventory. And prepaid expenses means that we've paid for an expense in advance of owing for it. So it is an asset. It's going to provide a future benefit to the company. Total current assets is going to be the sum of these four amounts. So notice I'm adding them here to get $38,000. Lastly, we're going to add in our long-term asset, meaning we're going to convert it to cash or use it within greater than 1 year from the balance sheet date. So property, plant, and equipment is a catch-all for things like buildings, land, vehicles, and we have a balance of $12,000. To calculate total assets, we're taking total current assets of $38,000 plus the property, plant, and equipment net of $12,000 to get $50,000 as total assets. You know that if the total assets are correct at 50,000, that total liabilities and stockholders' equity also has to equal 50,000, because we're going to show that our total assets equals total liabilities plus total stockholders' equity, just like our accounting equation. So we have our current liabilities, meaning that we're going to pay them or need to pay them within 1 year from the balance sheet date, typically much quicker than that. Then we have our long-term liability here, note payable, and our total liabilities, which is going to be total current liabilities plus our long-term liabilities. Down below, we have our stockholders' equity section. So I want to point out one thing specifically. Retained earnings is from the statement of retained earnings. We need the balance, the ending balance of retained earnings, in order to balance the balance sheet. So we need to carry that down, the 35,000 down here to our balance sheet. If you've prepared your balance sheet and you are not balancing, always double check that you're using the correct retained earnings balance, the ending balance. And notice here we're going to add up these three amounts to calculate the 41,000 total stockholders' equity. And then we're going to take total liabilities plus, total stockholders' equity. Sum of those two amounts, 9 plus the 41, gives us our 50,000 total liabilities and stockholders' equity. And this is just showing you that, yes, they do match. They're supposed to match, internally consistent. The last financial statement that we prepare is the statement of cash flows. So we're showing how the company spent and received cash during the year. ABC Corporation, statement of cash flows. And notice again, we're back to for the year ended December 31st, 2018. The statement of cash flows has 3 sections. We're not going to get into the depth of the operating activities in this chapter, but the operating activities is going to be the most important section. That's where you want to see the bulk of your cash coming from. So we start with net income from the income statement. And what we're going to do is we're going to adjust. So adjustments to convert net income to a cash basis. This number is given, as are all the other numbers. Since these both are positive numbers, we're going to add them together. If one was a negative, we would net them. So net cash provided by. So net cash provided by means that we had positive cash inflows. So provided by equals cash inflows from that category. Under investing activities, this is what we've used and received cash related to the purchases and sales of long-term assets. So for instance, property, plant, and equipment. We made a purchase, $10,000 outflow of cash. Notice it's negative. And proceeds from the sale of property, plant, and equipment, cash inflow. So we netted these two amounts to calculate 2,000, again, net cash provided by for this category. The last category is our financing activities. So anything having to do with our shareholders. We've issued common stock. We've reacquired common stock in the form of treasury stock. If we've paid any dividends in cash, we'd see them here. Items like that are going to be listed below. So purchases of treasury stock, we have an outflow of 10,000. Principal payment of long-term debt, an outflow of $2,000. Net cash used in, notice the difference in wording, used